What is happening, investors? It is your boy Jack. I am not a financial advisor, and today I want to speak to you about my top 6 Dividend King picks. A Dividend King is a company that's in the S&P 500 that has increased their dividend payout every single year without fail for over 50 years. Recently I made a video speaking about my top 10 dividend aristocrats, and loads of people asked me to speak about more dividend stocks, so I said, you know what, it makes sense, let's speak about some kings. Today I've chosen my 6 favorite dividend kings, all of which I own, so you know I'm not just speaking about them for the sake of it, and I'm going to touch briefly on each of them and why they may or may not be a good investment for you. 50 years of increased dividend payments. These guys have been through everything. They've been through the Great Recession, they've been through tech booms, through oil crashes, they've been through everything, and still, every single year without fail, been able to raise their dividend and reward their investors. So for the long-term investor, for the long-term dividend investor who one day would like to live off of their dividends and only wants to invest in very safe companies, these will be some good picks for you. Like in my Dividend Aristocrat video, I'm going to speak with the company that pays the lowest dividend and we'll work our way up. First of all though, I have to say, whoa, you guys are crazy. I mean, the channel is doing amazingly. We're up to 4,500 subs already. We only hit 4,000 like, I don't know, 3 days ago maybe. You guys crazy, man. There are still a lot of you who aren't subbed yet though, so if you're one of those people, please hit that red button now. At 5,000 subs, the full portfolio reveal is coming and I am very excited for that video. Please do smash the video like, it helps me out so much. I really do appreciate every single one of you. And drop me a comment down below, let me know if you own any Dividend Kings, whether it's one I speak about or one that I don't speak about. With all that being said, let's get straight into the first pick of the day. We are kicking things off with a company that everybody knows and loves. We have Procter & Gamble, and I guarantee a lot of you guys watching this video own a position in this company right here. So, a dividend safety of 99. That says a lot in itself. A dividend yield of 2.78%. So for a company who's been paying a dividend for this long, that's acceptable, you know. Generally, I like to be looking for at least 3.5%, 4%. But you know what? For a company like this, I'm not too upset about it. And I also do have that uninterrupted dividend streak of 62 plus years. And of course, the dividend growth streak of 62 years. So these guys sell household products. They sell things that people need. And that is why I believe that throughout the years, throughout everything that's gone wrong, these guys have performed so well. They're not cyclical in nature. They sell things that people need, regardless of the economic situation that the world is in at any given time. I mean, we just have a look at the kind of products that they sell, okay? Tide pods, Ariel pods, things to clean your clothes, okay? Everybody needs to clean their clothes. Lady products. Look, I don't care how little money you have, or if times get really tough, or if you get laid off, you're going to buy your lady products if you're a female. And the same goes for male products, you know, your shavers, things of the like. And then we have Pampers. Your baby needs their diapers. Kitchen rolls, toothbrushes, things to clean our dishes. You get the picture. They sell things that people need. And when you sell things that people need, it doesn't really matter how much money people have, they're going to buy your products. And one major reason why I believe these guys have done so well and been able to raise that dividend for over 60 years is because each year Procter & Gamble spends close to $2 billion on research and development, carrying out thousands of studies to gain consumer insights and develop relevant product technology. So they're always innovating, they're always coming up with the next product, they're always making their current products better. They regularly spend more than $7 billion a year on advertising, which is more than 10% of their sales. And that's why you know these guys, you know. Even if you didn't know that PG was the company behind them, you know their products and you'll more than likely use some of them. Most of the company's $21 billion brands boast number 1 or number 2 positions in their category or segment. And P&G is number 1 in 7 of its 10 categories. So basically, they are just absolutely dominating the market. 21 different billion-dollar brands. They're so diversified. And pretty much every one of those products is a necessity. And then one more thing that I really love, and you'll know this about me. The company also boasts the largest amount of e-commerce sales in its industry. In fiscal 2019, online sales grew 25% and now account for 8% of total revenue. This is something I absolutely love to see because my view is that an awful lot of the world is moving online, and an awful lot of products that you buy in shops as of right now, in 5 or 10 years, you could be buying online. It's already beginning to happen. So these guys clearly understand that that is happening, and they're making sure that they get into that space sooner rather than later. So not only can you buy them in the shops, you can go and buy them online. We have a look at the max stock chart, and it's one of these companies where we see, you know, yeah, they can have their dips, but overall, the upwards growth is quite nice. Now, It's not one of these companies that you can expect to invest in and it's going to make you rich. It's going to give you back thousands of percent in the decades to come, you know? It's not a growth stock. It's not a Facebook or a Tesla or a spec stock or anything like that. What it is it's a relatively safe company who you can expect to pay you more on your share price alone and pay out a very, very safe dividend. In the last 5 years, it returned about 60%. Now it's sitting down at about 47%. So you can see it's not one of these crazy companies that's going to give you an awful lot of money. But I do definitely see a place for a company like this in my portfolio. I always want to have some portion of my portfolio in these really safe long-term stocks. And today we're going to have a quick look at each company's balance sheet. Okay, so a quick look at P&G. Total current assets 27 billion. Total assets 118.5 billion. Current liabilities nearly 33 billion. Okay, and then total liabilities 72.6 billion. So from a long-term point of view, money is in quite a good way. Okay, short-term, it's not the best in the world. It's quite clear to see, but I think they're going to be absolutely fine. I think they're going to do a lot better than a lot of different industries will right now. That's it for Procter & Gamble. Now, on to company number 2. Remember, the dividend yield is going to go up each time. Okay, so it turns out I'm a little bit of a liar. We're looking at Johnson & Johnson, and their dividend yield is 2.74%. So it's 0.04% less than Procter & Gamble. But it's not the biggest deal in the world, okay? Again, we're looking at a company with a dividend safety of 99, and again, we're looking at an uninterrupted dividend streak of 57 plus years. So these guys are in pharmaceuticals, okay? That is what they sell. So it's not necessarily your household products, it's not your soaps and your toilet papers, but it is still products that everybody needs. So they have dozens of patented drugs and vaccines, okay? Medical devices, so surgical, orthopedic, endomechanical, hip replacements and sterilization equipment, and then your consumer products is just your over-the-counter consumer medical and beauty products. Here's some of the big names that belong to Johnson. So obviously we have Johnson's, we have Aveeno, Benadryl, Motrin, Tylenol, Listerine, a lot of massive well-known names. And again, very similar to Procter & Gamble, these guys are always looking towards the next product, okay? 15 to 20 launches in 2018, 20 to 25 launches in 2019, and 40 to 50 launches in 2020 and beyond. So they're always getting new and updated products into the market. And again, it's a company, when we look at the max stock chart, we start off on the 5 years stock chart. We can see in the last 5 years, they gave us back about 55%, not including the dividends. If we look at the max stock chart, again, we can go back kind of around the 2010, 2009 levels, and we can see 160%. So they're not one of the companies who's going to make you rich, you know, they're really not, but they're one of these very safe companies. And that is oftentimes what these dividend kings are. They're companies that you don't expect to pay you the most money in the whole world, but you know, a nice steady increase and those nice dividends. Now, Johnson & Johnson do have a really nice balance sheet, okay? So current assets, 44.2 billion. Total assets, 155 billion. Total current liabilities, 33.7 billion, okay, and total liabilities, 93.7 billion. So both in the short term and in the long term, they are looking very, very good. And one other thing that should be mentioned, since we are speaking about dividends, in April, Johnson & Johnson hiked their dividend up 6%. So I see absolutely zero risk of the world that we live in right now having an effect on J&J's dividend. And it's another company who is pretty much back to their all-time highs. You know, they got hit, yeah, it wasn't even that hard. Look, very briefly they were down 27%. That wasn't for long whatsoever. Now they're down about 4.25%. They're performing absolutely fantastically. And again, another company I'm very happy to have in my own portfolio. Okay, so that is it. They are two that you knew were going to be in here. Now, on to our next ones. We are having a look at Sysco Corp, which is literally one of my favorite companies. Okay, so Sysco Corp, a dividend yield of now we're up to 3.23%. So an actual decent dividend, you know. A dividend safety of 55. And we go down, they have that dividend growth streak of 51 years. Now, if you don't know who Sysco are or what they do, they're the largest global distributor of food in the world, okay? They act as a middleman between food producers and retail consumers. So these are a company who have been hit hard by the crisis. Restaurants are 62% of these guys' sales, and you all know that an awful lot of restaurants are completely shut down right now and have been for the last month and a half, 2 months. Now, some positive news is starting to come out. Some countries are opening back up some restaurants, so these guys might be able to pick up some business relatively soon. I want to go to the 5-year stock chart, okay, because these are companies who I actually really like the look of at this kind of price point, okay? So if we go back 5 years ago, up to the peaks, they gave back, you know, pretty much 130%, which for a dividend king is genuinely a very nice return, okay? And now what we'll do is we'll go down to the 6-month chart, okay? We can see that from highs to lows, we dropped, where are we? About 60%. And we're still down about 31%. So it's been a great recovery from the bottom, up nearly 80%, but they're still down 30% from those highs. Me personally, I got into them at a very good price. I'm up over 20% in them right now, so I am happy. but I just think they've so much more room to go to the upside, and I don't think it's going to be a very slow recovery for these guys as restaurants start to open back up. Hotels, schools, healthcare facilities, when all these things start to open back up, okay, these guys are going to be straight back to making money. You know, these guys are used to dealing with Sysco. They're going to go straight back to them, and Sysco is going to pick up where they left off. So I see this as a very good price point for a company like Sysco, who, when we have a look at the max stock chart, you know, for the last 10 years has seen some really nice growth. Now, there was this really stagnant phase here, I understand that, but ever since then it's been some really nice growth. But again, they sell things that people need. Everybody needs their food, you know, and these are the largest global distributor of food. So a few points of note in regards to these guys, okay? They're the largest food product distributor in North America with approximately 16% share of the $300 billion food service market in the US. They have more than 14,000 delivery vehicles, which allows them to offer daily delivery to most of its customers and provide very competitive rates. They serve 650,000 customer locations. They can leverage its fixed costs to offer more competitive pricing than other distributors that attempt to play in its geographic regions, because a lot of people don't have the size that Sysco have. They tried to acquire the number 2 biggest player in the market, US Foods, for $8.2 billion in December 2013, but the acquisition would have given them a 25% share in the national market, but it was blocked by the US government, okay, which required Sysco to significantly alter its core strategic plan. Now, this happened back in 2013. Since 2013, they've gone up over 165%. So this didn't really, you know, put much of a spanner in the works. They did adapt, and look, they're doing very well now today. So the balance sheet, current assets nearly at 10 billion. Total assets 20.4 billion. Current liabilities only at 6.6 billion. And total liabilities at 18.3 billion. So by no means the absolute best balance sheet in the world, but I don't think Sysco is going anywhere whatsoever. I do really like them. They've treated me very well so far, and I do most certainly plan on buying more going forwards. So with all that being said, company number 4. We are having a look at Coca-Cola. Okay, so now a 3.5% dividend yield. So a very respectable dividend yield, okay? A dividend safety of 80. And we go down to that dividend growth streak of 58 plus years. Now everybody knows who Coca-Cola is, you know what they sell. They have 21 different billion-dollar brands, all of them listed here. You have your Coca-Cola, Coke Zero, Diet Coke, then things like Georgia, Fanta, Dasani, Sprite, Smartwater, loads of different beverage companies. And again, it's a company who's trying to keep up with the times, okay? Currently, just under 70% of Coca-Cola's unit sales are still from sodas, but the company has aggressively been diversifying into energy drinks, juices, water, and dairy. And I think a lot more people are getting a lot more health conscious, so the likes of your juices, your water, things along those lines are going to help these guys out in the future. Coca-Cola is Warren Buffett's 3rd biggest investment as of right now in value, with an awful lot of shares, 400 million shares. So I mean, this guy has 18.7 billion in the company. He owns nearly a 10% stake in the company. Coca-Cola is the 5th most valuable brand in the entire world, coming only after Microsoft, why is this loading so slowly? Ooh, Amazon, Google, and who's the very biggest? Oh my days, Apple. I apologise for just how ugly that loading in was. We have a look at the balance sheet. Current assets, 28.2 billion. Total assets, 94 billion. Current liabilities, 32 billion. And total liabilities, 74 billion. So again, one of these balance sheets that is not the most impressive thing in the whole world by any means. We have a look at the 5-year chart, okay, and from 5 years up to the highs was, you know, just under 50-ish%, and as of right now, it's only up 15%. So on the 6-month chart, we are still down a considerable amount. We're still down about 21%, which is not good whatsoever, and is quite surprising to me, considering, you know, a lot of people are still going to buy their products. You know, people are going to go to the shop and buy their can of Coke, or buy their bottle of Fanta, buy their bottle of Dasani water, whatever it is. I will say right now, I prefer Pepsi. I've spoken about this in a few videos before, but I do prefer Pepsi to Coke. But Pepsi only has a dividend growth of, I think, 47 years, so they can't make this list. So if we're speaking purely about 50-year Dividend Kings, Coca-Cola takes it. So, I mean, if you got into them 40 years ago, you've made nearly 8,500%. You're very happy. But recent history has not been anywhere near as pretty, to say the least. The last 10 years, they've returned, where are we? Only about maybe 130-ish% at the very top. So again, it's average, you know. You expect to get that 10 to 15% a year off a company, and then you get that 3.5% dividend as well. The last 5 years have been even worse, okay? As I said, we've only gone up about 46-ish%, so it really hasn't been the best. But what might be worth doing now is getting in at a decent discount, and then your return for the next 5 to 10 years could be a whole lot better. I'm going to leave Coca-Cola there. We all know who they are. They're not too exciting. Now, we actually have two slightly more exciting stocks. Boom, we have 3M up on the screen, okay? So, dividend yield of nearly 3.8%. So again, a nice dividend yield this time. We're actually getting to the kind of dividends that we want to see. A dividend safety of 75. And a dividend growth streak of 62 years. But they've actually been growing their dividend fast. The last 20 years, we've seen 8% per year, which is fantastic for a company who has paid it for 62 years in a row and grown at 62 years in a row. 3M is a highly diversified company with 5 main business segments that cover over 45 technology platforms, range from adhesives and abrasives to ceramics and nanotechnology, okay? So industrial, which is 35% of sales. That's tape, sealants, abrasives, ceramics, adhesives, all of that kind of stuff. Healthcare, infection prevention supplies, drug delivery systems, food safety products, safety and graphics, 17% of sales. Personal protection and fall protection equipment, traffic safety products, electronics and energy, 15% of sales. Insulation, splicing and interconnection devices, touchscreens. It goes on. And then the last one we have is consumer products, which is 14% of sales. Post-it notes, tape, sponges. So, very, very diversified company. And these guys have actually paid uninterrupted dividends for over 100 years. That's pretty cool. So we're going to start it off by having a look at the max stock chart, okay? And we can see that there was never really much of a downward play until the Great Recession. And then since then, from lows to highs, that went up over what? 350% in less than 10 years. Now we go over to the 5-year chart, okay? And the last 2 years have actually been quite poor. And we can see that right now, they're down 40%. Now, if we go to the 6-month chart that we can see from highs to lows, we dropped as low as negative 35%. And as of right now, they're down about 14%. So it's been quite a nice recovery from the lows up to the highs. They've gone up 31-ish%. So another company who has an incredible track record up until the last few years. And I know this does put a few people off, but to me, it's really exciting. You know, it means that I can be getting in at a price that I could have gotten in 5 years ago. You know, to me, that's exciting. If I don't think that the company's fundamentals or long-term outlooks have changed, of course I want to get in when it's cheaper. Do I think that $258 was the highest that 3M will ever go? I most certainly don't. I really, really don't. I could see them going a whole lot longer if this is an investment that you're willing to hold on to for 10 plus years. Total current assets, 15 billion. Total assets, 46 billion. Total current liabilities, 9 billion. Total liabilities, 36 billion. So a great balance sheet. You know, they're more than able to handle whatever's being thrown at them at this moment in time, and they're going to bounce back very strongly. Management has previously estimated that about 33% of the firm's sales are from products launched in just the past 5 years. So again, a company who is not just sitting back. They're always looking to make better products, new products, to be the innovators. And although they fell on a particularly tough couple of years, and then this particularly tough, very short period of time, I still 100% believe in them in the very long term. The recovery for these guys could be relatively slow in all honesty, okay? I don't think they'll be one of the first companies who starts to see the benefits when economies start opening back up. I think it could take a little bit of time, but I also think that from a long-term point of view, these guys are an absolutely fantastic investment, okay? With all that being said, we're on to the very last company of today. We are looking at Altria Group, ticker symbol MO. Dividend yield of 8.59%, guys, for a dividend king. Dividend safety of 55 and dividend growth streak of 50 years. So they're very, very new to being a dividend king, but 8.59% dividend yield, guys. That is crazy. That's crazy for any company to be paying. Never mind a company who's been paying their dividends and increasing their dividends every year for 50 years. Now, I get very, very excited about this company, okay? Because I would be prone to invest in these guys as a growth stock, not even because of the dividend. I genuinely believe that these guys are doing such a great job of setting themselves up for long-term success, for investing into, you know, emerging markets. I think that they could be a massive, massive name in more than just what they do right now. So as of right now, okay, they're America's largest tobacco company. But what I really want to focus on is what they're looking into, okay? So they're in Kronos Group, an emerging global cannabinoid company. They're in Abinbev. They have a 10% investment. They sell wine, okay? They're in Juul, the US's leading electric cigarette, vape, whatever you want to call it, nicotine patches. They're in a lot of these emerging markets. Now, the thing about cigarettes is that less and less people are smoking every single year, and they have been doing so for decades, okay? If we look at this chart, I know it's for Great Britain, but you get the picture. From 1974, 51% of men in Great Britain were smoking, and that's gone down every single year pretty much. As of 2014, it was 20%. As of right now in the US, it's 14% of people are smoking, from 50% only a few decades ago. So we would have expected that, you know, MO wouldn't have done very well the last 30-40 years. Well, I mean, if you invested back in 1980, okay, and you got out at the very highs, you had made over 20,000% in 37 years, despite the fact that less and less people are smoking. Now, with that being said, it's been a rough few years, okay? From the highs that were, you know, nearly exactly 3 years ago to where we are now, we're down almost 50%. We go to the 6-month chart. From the highs on that 6-month chart, as of right now, we're still down 24%. I'm looking at a company with some absolutely insane growth history, who has been hit very hard the last couple of years, who is emerging into all of these up and coming markets and already has a massive market base. Is really exciting to me. And then on top of that, they have, where are we, that 8.59% dividend yield. I mean, it's amazing to me. Obviously things could go wrong, they could keep going down, but I think the risk to reward ratio here makes so much sense. Looking at the financials, okay, nearly 8 billion in current assets, 52.6 billion in total assets, 11.1 billion in current liabilities, and nearly 46 billion in total liabilities, okay? So again, one of these balance sheets are not the best in the whole wide world, but do I think they'll be able to get out of it okay? Yes, most certainly. I just see this company, right, as one where, you know, I'm probably either going to make literally 300, 400, 500% in a matter of 10 to 15 years and a whole lot of dividends, or I'm going to lose 30, 40%. Like, to me, the risk to reward makes so much sense. But that's where I'm going to leave these guys. Look into them. They're amazing looking. So guys, that was my 6 favorite Dividend Kings, okay? I know there's been a lot of videos lately about Dividend Aristocrats, growth stocks, just top 5 stocks in general, but they've been very requested videos, so I said I'd go ahead and make them. We've some really exciting videos coming soon. One being my full stock portfolio at 5,000 subs. I cannot wait to make that video for you guys. I also have a few more individual stock analysis videos going up soon. AT&T is one 100% coming. If you want me to analyze any other stocks, drop them in the comments down below and I will be sure to consider them. Hopefully you guys did enjoy this video. If you did, please smash the like button and subscribe if you haven't yet. We are so close to that 5,000 mark. I appreciate you all so much. Hope you have an absolutely fantastic day. I will catch you all for tomorrow's video. Have a good one. Peace.